The power in real estate is being able to see the future when very few can. And once you know what you're doing, your education will give you the insight to what the future is going to be. Another Hey, you guys, welcome to another episode of Keeping It Real Estate. I'm your host, Dan Brisse, and we've got a great episode for you today, all about the state of the market and being able to pick that right deal for you based on criteria. You know, we know most folks are sitting on the sideline right now, waiting for the bottom to be in, waiting for that certainty of, okay, great, I can go out there and buy more deals. So if you're contemplating about when the best time is to make your next real estate investment, then this episode is for you. And we're going to take a close look at what some of our industry experts are saying and what we're seeing real time. So let's dive into the top 3 reasons that we're buying right now. Number 1 is just strong market fundamentals. You know, nationwide occupancy and rent growth are still very strong, and there is still a major housing shortage in this country. Certain submarkets are seeing some serious rent growth, and there's massive pent-up demand. And the point I'm going to say to that is, you know, you've got a lot of people that'll come on and say nationwide rents are dropping, and that's just a far too blanketed comment, in our opinion. Depending on the submarket you're buying in, depending on so much more than that, rents are not necessarily falling. In fact, if you can buy a deal where the rents are below market because you've got an owner that has massive deferred maintenance and they're strapped on cash, that could be an amazing deal if you can buy it based off of the value today. So, you know, to say that this is not the right time, pencils down, I don't agree with that necessarily, as long as you know what you're doing and you've got the right debt and you're in the right submarket. And if you can be underwriting right now for taxes based off the last 2 or 3 years, they've been brutal. And insurance, it's been brutal. So you're buying right now with interest rates high, with cap rates high, with property taxes and insurance high, all helping you, all while we've had major NOI growth on a lot of these assets over the last 24 months as we've seen destruction. You know, and as you guys know, number 2 point for us, there's been an unprecedented delivery of new construction in the past 2 years, and this trend is about to slow down. You know, they've been building hard, and when rates went up, they stopped new builds. New multifamily construction starts have dropped 47% from Q1 2023 to Q1 of 2024. When this pipeline of construction runs out, expect upward pressure on rents and further increased demand for apartments. Deliveries are expected to peak in 2024 and then decrease thereafter. So you've got these deliveries of new builds that are going to come on the market. They're going to affect rents. They already are. But if you can buy in a demographic that, or a class of asset that is not affected by new builds, this does not apply to you nearly as much. And a lot of the workforce housing we're buying, they're not affected by the brand new builds coming online. The A-class product is not going to our workforce housing demographic. In our workforce housing demographic, they're in C-class property. And it's not, I'm going to live here for a year and then move to another apartment, or live here for a year and buy a home. This is home for them. So, you know, you got to have a niche. You got to have a niche. You got to have something you understand and you can see the future. The power in real estate is being able to see the future when very few can. And once you know what you're doing, your education will give you the insight to what the future is going to be. Another big factor driving demand in the market is that many investors are sitting on mountains of cash right now, waiting for the perfect time to buy. And I personally believe this is a mistake. You know, once that capital rushes back towards the market and rates flatline or start to pull back a few bips, we're going to see a tidal wave of cash that's been idle put some price increases. And so you have to be positioned now or before that starts to get the bottom pricing. There's a quote that sums it up really well from the former chairman and CEO of Goldman Sachs. And it says, if you're sitting by the phone waiting for it to ring so someone can tell you the market hit bottom, it will never ring. That quote is something that I think is needed to be read and heard today. It fits for where we are in the market cycle. And another one that comes to mind for me is Warren Buffett's famous quote of, when others are greedy, be fearful. And I can tell you right now, a lot of syndication groups should have been much more fearful in 2021 and early 2022 and all of 2022 really, and waited and been selling. And now we're here in a market where everyone's fearful. and it's time to get a little bit of greed on from our perspective. So this window has opened up. It's been since 2009 since we've seen a buying window like this, and we've got a couple years, 2-3 years, where we think we're going to be able to get some of the best deals we've found since 2009, since the Great Recession. So that's just some of the reasons why we're buying now. And, there's some talk in the market by industry experts saying that October of 2023 was the market bottom when the 5, 7, 10-year ran, I think it got just north of 5% or right around there. And since that point, we've seen it pull back, and the belief is that was the bottom and we're on the way out. So with that in mind, there's a few things we want to add is just, in order to find a successful deal, in order to find success in real estate investing, you need a clear plan with what you're looking to buy. We call it our investing criteria. So if you're out there and you're looking for a deal and you want to buy now, your buying criteria, your buying box needs to be super clear. And if you don't have that, you don't know what that is, you need more education. Otherwise, you're going to be underwriting deals for days. You're going to be all over the place. You're going to be in every market. Every time a broker sends you a deal, you're going to underwrite it thinking it's a deal. Most of the deals we get, you guys, we'll probably get 500 deals a year, and we'll probably underwrite 200 of them. We won't even look at the other 300. We'll just look at them and say, hey, it doesn't fit our criteria, it doesn't fit our submarket. We don't know enough about it. Doesn't mean it's not a good deal. Just doesn't mean we know enough about it. And we don't want to put our time and effort into something we don't know about when we can hit a rinse and repeat model for us. Something that we found success with, something that we believe we can move the needle on with a very certainty level of confidence. So a few pieces to discuss in your criteria as you build it out is, are you going to use bridge debt or are you going to use fixed debt? Bridge debt is variable rate. There's some positives to it, is that you don't have a prepayment penalty. The negatives are obviously you got to buy the rate cap, and if rates run, you're screwed. And we're in that situation right now. We're seeing it with those deals that are most distressed. Most of them have a bridge loan and they're underwater, or they need to buy a rate cap and they don't have it, and they got to go to market to liquidate what they can and get out of the loan. So get clear on that. Are you in that position of wanting to take that risk, or you want just lower leverage, fixed debt, a little bit more boring? You might hold your deal a little longer due to a prepayment penalty, but you've got more certainty and control. We at Granite Towers, we like low leverage fixed debt. That's just where Mike and I makes us feel better, to sleep better at night. We love that 60% to 75% loan to value. We like to have all of our CapEx as cash, don't finance it. So we have more control, more flexibility. And that's just what suits us. If I'm in your shoes, I'd clearly determine your target loan to value. What are you guys comfortable with as an owner? And I can tell you, most folks who bought in 21 and early 2022 wish they would have selected a loan with lower leverage, because during that time, people came in with greed, levered everything up, and now that's the blood you're seeing in the streets. You got to know what you're looking for. Where do you want to be and why? What specific asset class are you buying and why? Is it office? Is it multi? Is it storage? Is it retail? What is it? And then why? And do you have an understanding of being able to look at that deal and see the future? When I say be able to see the future, I mean you can create a new level of income and expenses, and you can see where the market will be in a 3 to 5 year period and be ready to exit for your investors. It's impossible to find a deal if you don't know what you're looking for. So that's where criteria is critical. Again, here at Granite Towers, we prefer low leverage deals just to insulate us from the market's volatility. Just like the market is showing us right now, it's just huge volatility. We use agency debt, 5, 7, 10-year debt, depending on the deal, depending on the business plan. And it does potentially make us have to hold the deal for longer, because if, let's just say, rates come down, you might have a larger prepayment penalty. But if you can stay in that cash flow position, you've got CapEx to take care of your deal. Is it really that big of a deal? That's what we're looking for with our investors, is people who are thinking more long-term. We're here for an investment, not the flipping mentality that, ended up happening late 21, all of 21, and even 2020. It turned into a flipping game. We buy a deal, 12 months later, we double everyone's money. That's just not what real estate has been designed for, and that's not what it's been in the past. And, that's not really our game. And, the nicest part about fixed debt is you can weather a storm and not be forced to sell. I'd rather be in a position where I can choose when to sell than be forced to sell. Because if I can choose when to sell and pay a higher prepayment penalty, I'm making that decision. Whereas if I'm forced to sell, I might be wiping out all equity, which is happening right now. We buy multifamily where we can add significant value. And the real basic play of what we're doing is we're just renovating units and pushing rents to market. We're renovating the exteriors. We're bringing the unit up to what the market is already doing. So we're looking for submarkets that have massive pent-up demand. And we know we have massive pent-up demand when we're seeing 95 to 100% occupancy. And when we're seeing 95 to 100% occupancy, we know that we can move rents much more easily because we know that there's a major supply demand imbalance and it's in favor of the people who own these deals. And if you're buying a deal that won't be affected by A-class property because it's workforce housing with low leverage fixed debt, it gives us more confidence that what we're projecting will be able to create. So all of this to say, in order to find success in this market, you really have to know what you're looking for, and you got to pursue it aggressively and be able to underwrite the deal to be able to, again, see the future. And we've seen pricing come down dramatically, you guys, in the last 18 to 24 months, like 20 to 30% in the past 2 years. So the investors who have access to equity and are sophisticated investors, they're out there buying right now. We've been talking to brokers throughout Dallas, Fort Worth, Nashville, and the buying pool has changed. It's a buying group that either has been not buying lately, or not buying during 2020 to 2022, or have been around a lot longer. So I think those are signs that you've got a sophisticated group showing back up instead of the greedy group. One other thing I'll just say about the market selection, you guys, is be very, very cautious of a demographic that may have a sense of entitlement after COVID. And unfortunately, that's been created by some demographics out there. And you as an owner of the business need to be aware of that. If that's your customer, they're going to be very challenging to deal with. They're going to be very difficult to continue to keep paying rent. And there's been markets, I would say, now have changed, and sub-markets that have changed. And so the opportunity is strong, but you have to know what you're looking for. This comes back to your buying criteria. So hopefully you heard that. Moving on to one last piece that I think is important to talk about is property management. Property management is everything. And your ability as an asset manager to manage that property management company will dictate the success of the property. And you have to become great at hiring a great property management team. And if you can't do that, your life as a landlord is going to be miserable. Keep in mind, expenses have risen. So efficient management practices are now way more essential than ever before. You're able to see who knows what they're doing and who does not. You need to ensure that the team you're investing with is partnered with a strong property management company with a firm track record with that property management company. I wouldn't invest with anybody who hasn't done at least 5 to 6 deals and hasn't been around, since 2015. Just look for another general partnership group. It's not worth the risk. You also want to be certain that you have a great asset manager. A great asset manager generally is somebody who has worked at a property management company for years, can speak the property management language, and knows how to think like an owner. Those people are not very common. It's not very common. So if you own an investment firm, or if you're going to be owning real estate, multifamily real estate, and you don't want to asset manage, I would go to a property manager and see if you can't get in with a regional and persuade them to come over and be, on your team. The thing about that is, if you're going to persuade them to be on your team, you got to think long-term for that person, not pull them away, buy the deal for 2 years, sell it. Now they may not have a job, or just be upfront with them about your plan. One thing that we can leave you guys with is, if you want to learn more about how to select the best team to invest with, click the link in the description to access our ebook. It's the 4 steps to passive investing. And we believe that right now is the time to buy multifamily at the largest discounts we've seen since 2009's Great Recession. The pain has already been inflicted with these uber high rates in place, and the cost per door has pulled way, way back. And the biggest thing is we've seen NOI increase. If NOI decreased massively and pricing pulled way back, that would be a totally different ballgame. But you've got more cash flow now at a higher cap rate, with higher interest rates and lower leverage, with the very likely chance that you're going to have wind at your sails. And I say wind at your sails, I mean you're going to have a likelihood of interest rates coming down some. When, I don't know, how much I don't know, but it's likely they'll come down based off history's patterns. Based off of that, cap rates will follow some. How much, you don't know. But again, it seems like the window is definitely open to us. And based on these real-time data facts, we are buying, and we'll definitely be buying apartments over the next 24 months. And just a reminder, we focus on Dallas and Nashville, just those 2 of the nation's strongest markets in terms of job growth and population growth. And I'd say one thing Mike and I would change if we're going back is that we would have dialed in our markets much sooner. We wouldn't have jumped in so fast into some of these smaller markets, because the smaller markets, yes, they can be enticing due to the cap rates or what you think you're going to put in your spreadsheet for cash flow. But in all reality, when things hit, those deals suffer earlier sometimes, or they don't have as stable economies. So these markets are also, they're super business friendly. There's no state income tax, which attracts employees and businesses, also driving sustained economic growth. Additionally, Dallas and Nashville are very landlord friendly, meaning the minimal rent control laws, and they're fast to evict in comparison to states like New York and California. So if you'd like to get to know us better, Mike or myself would be happy to have a one-on-one conversation with you to discuss your investment goals or to discuss any other concerns we may not have addressed here. You let us know, and we'll bring a podcast out to anything else on your mind. Thanks for tuning in today. Please leave us a 5-star review if we added value to you, and share it with a friend if you think we bring value to you. And we'll see you guys next week. Thanks so much.